how do we invest during a recession? It's no secret. A lot of people are saying it. A lot of people believe that we are going into a recession. I made this resource a couple months ago. I did a video on this where I looked at historical, reliable recession indicators, or actually in this case, not recession indicators, but bear market indicators, because looking through the lens of an investor, what we care about is a bear market coming. Now, a lot of times a recession and a bear market are correlated, but believe it or not, the stock market is a leading indicator for a recession. So the stock market will generally drop before a recession because markets are forward looking. If there's a recession on the horizon, jobs are going to hurt, businesses are going to hurt. So the stock market will drop before a recession in most cases. So on this visual right here, the gray bands are bear markets and these colored regions are indicators. So 2022, we had a short little bear market, not as short as COVID, but we had 3 indicators lining up for 3 quarters before we had the recession. For COVID, or I guess that's really just 2 quarters. For COVID, we only had a very short warning, but we had 4 indicators stacking up. Going back to 2008, we had 4 indicators. For the year 2000, the dot-com bubble, we had 3 indicators before the bear market started, and then we did go up to 5 in the earlier portions of the bear market. I'm not going to go all the way back through all these, but the point is, here we are, and the last time I updated this information was in August of 2025. As of August, we've got 1, 2, 3, 4, 5 of these indicators stacking up. So signs are pointing towards a recession. It's not guaranteed, or signs are pointing towards bear market, but if there's enough indicators, if the market believes a recession is coming, or if the market believes a recession is coming, the stock market is likely to dip. And just to quickly go through some of these indicators that I'm looking at, valuation just references how overpriced stocks are in general compared to their earnings. Leading economic indicator goes over job expectations. It goes over interest rate expectations. It kind of is a conglomerate of a whole bunch of indicators that are forward-looking. A rate drop, whenever interest rates drop, that's generally because we're about to head into a recession. We're seeing a rate drop. High margin usage increases the risk that the stock market will go into a bear market. Recession, so the red regions are recession, just to show that generally speaking, the bear market begins before the recession does. And then a 10-2 inversion. This is talking about the 10-year and the 2-year interest rates. If those rates invert, it's often a key indicator. So we're seeing a lot of these stacking up. Looks like we could be going into a recession. So I'll repeat the question. What is the best way to invest during a recession? And I'm not talking about changing my current investments. I'm talking about how I'm investing new money. Generally, I am not going to be buying and selling investments very often. I like to buy a stock and hold it for a long time. I'm not looking to buy and sell a lot, because the more I touch it, the more I'm prone to making emotional mistakes. If the research says it's good, I'm going to stick with it. I also don't want to have more tax events than I need. So how am I investing new money? The first school of thought is, well, just buy a defensive stock. And there's nothing wrong with this. But for me, it's not quite my favorite way to do things. Now, what is a defensive stock? These are companies like Procter & Gamble, Johnson & Johnson, Coca-Cola. They are not tied to the cyclical nature of the economy. They're consumer staples a lot of times, things that people need no matter what. So, and consumer staples is one of the sectors that falls under the defensive stocks categories. We have utilities. People need water, gas, electricity. Consumer staples. People need hygiene, tobacco, food, beverages. People need these things whether the economy is doing well or not. And healthcare stocks are a big one. And apartment REITs, they list as an example. People need housing. So my school of thought here is I want to combine a couple of these categories. So when I'm thinking about a REIT does well as long as the business that they are, I'm jumping ahead a little bit. As long as the tenant doesn't leave, the REIT is getting their rents, they're getting paid. And so if we're thinking about commercial REITs, the REIT doesn't care as much if the business is thriving. The REIT really cares if the business starts to suffer so much that they need to downsize, that they need to move out. So what if I'm focusing on REITs that are in these categories: utilities, consumer staples, and healthcare, companies that are very unlikely to go out of business during a recession? And as long as they're not bailing on their lease, then the REIT is, they're pumping out their dividend no matter what. So the way I like to invest leading into a recession is, number one, of course, defensive companies are good. But if I can have a REIT that specializes in a defensive type of company, then that is the gold standard for me. It makes complete sense in my mind. I love it. So as an example, before I jump ahead, there's another category that I want to layer on top of the REIT being in a defensive category, and it's the style of lease. So if the REIT also has mainly triple net lease, then that is incredibly resilient during a recession. So what is a triple net lease? Okay, what is a triple net lease? Triple net NNN is a type of commercial property lease where the tenant is responsible for paying all of the ongoing expenses. That is taxes, insurance, and maintenance. So the thing that I like about this is it's very consistent for the REIT. They don't have to worry about taxes going up and hurting their profits. They don't have to worry about maintenance or insurance prices going up. They're just going to be a very steady, predictable profit. These are generally really long term as well. So the longer term leases that a REIT has on average, the more consistent their income will be. So if we have a recession and their average lease is like 15 years out, let's say, the recession's unlikely to last 15 years. It could, but it's unlikely to last that long. They generally don't. So as long as the companies within the REIT are not going out of business, they have price hikes built into these triple net leases, as well as generally 2 to 3% inflation on their lease payments. So the REIT is just chugging right along. And the downside, of course, is that they're not going to grow their dividends as much through just their tenants paying more and more, because the leases are very long term and they're just built in with that 2 to 3% increase. So the main way that these triple net lease REITs are able to grow their dividend is through acquisitions. Now, will they be able to acquire additional properties during a recession? If their cash flows aren't hurting and properties are suddenly cheaper, well, maybe it's a good opportunity for these REITs to even stack on additional acquisitions. So that's what I'm liking. So the first category of REIT that I want to quickly bring up is healthcare REITs. Now, I've actually just filmed a video on healthcare REITs. It's going to be coming out in the next couple weeks. So I'm not gonna go into a healthcare REIT, but I just wanted to give that quick preview that y'all can look forward to a video coming out on a healthcare REIT that I am really excited about. It has some really good political tailwinds as well. Some of Trump's policies are going to be really beneficial to this particular industry within the healthcare sector. So I'm really excited about that. Okay, moving on to the next. Let's talk about consumer staples. So a REIT that specializes in defensive consumer staple companies. The first one I want to point out today is Realty Income Corp. This is a super popular REIT. This isn't like I wouldn't be surprised if everybody watching has heard of this REIT, and you've heard of it for good reason. It is very, very good during a recession. So I actually have to go to a different website here. So on Seeking Alpha, it's frustrating that stockanalysis.com is where I usually like to go to pull up my stock information. They only go back 10 years on dividends. I wish they went further back. Anyway, we'll use another resource here. Dividend growth on Seeking Alpha. Here's 2024. So I can go all the way back. We can see, let's look at COVID really quick. During COVID, they did not drop their dividend. They actually increased their dividend by 4.7%. That was their yield. Sorry. Annual payout growth. During COVID, they increased it by 3% those 2 years. In 2022, we had a recession. They increased it by 7%. Only recently did they have a annual payout where they did not have dividend growth in 2024. It's the first time I've ever seen them not increase their dividend, going all the way back. I guess we could say since 1996. In 2000, dot-com bubble, they managed to increase their dividend. 2008, global financial crisis, they've been increasing their dividend. So this company has been incredibly consistent with their dividend. And and a dividend's not everything. So let me back up. I typically, whenever I'm evaluating a company, I try to ignore the dividend, because what makes a company undervalued is what kind of free cash flow are they generating? And that free cash flow is what's being returned to shareholders. Now, the dividend is just one component of the free cash flow. So I'm really focusing more on the whole lump sum of free cash flow, and the dividend just being one part of that. I don't pay so much attention to that. But during a recession, I particularly like dividends and share buybacks. I actually like share buybacks a little bit more because it's not a taxable event. But during a recession, if the company happens to drop in share value, but their underlying business is still humming along nicely, and their profits aren't actually hurting. People are just scared in a recession a lot of times, and so stocks will sell off because people will be fearful. And so even though the stock price might drop, if they're still pumping out that dividend, then I am still extracting value from that company without having to sell shares while it's at the bottom. And during those times when it's still pumping out its dividend and the share price is down, I can use the dividends to buy back shares of the company. And then for people who are needing to extract money from their portfolios to live off of, maybe during retirement, then a dividend stock is nice during a recession because they're not forced to sell as many shares while share prices are down. Now, on the flip side, when share prices are really high, they're really pumped up, kind of like they are now, you'd rather have the capital or the capital appreciation maybe and less of the dividend, because selling shares when they're overvalued is like kind of the perfect time to sell. So anyway, there's some give and take there, but specifically during recession, dividends are kind of nice. So Realty Income Corp, if we look at their dividend, they've got a 5.36% dividend. So that's kind of a bonus. The main thing I look at, and we're going to get into it in a minute, is what does their valuation look like in terms of their discounted future free cash flow. But before we look at that, hope I don't pick the wrong one here. Here we go, Realty Income Corp. So one of my favorite new tools that I've been using on Charles Schwab, I have access to rating changes. So I'm giving you all a little bit of a sneak peek here. Oh no. Okay, well, this isn't really working, but I can go down to right here. So Realty Income Corp. So this is the Morningstar analysis. So because I invest through Charles Schwab, I have access to professional Morningstar analyst due diligence on companies, which is really nice. So I've been enjoying using this lately to kind of look for undervalued companies and to have a reliable analyst projection on future revenues. So for this company, I'll just quickly go to their forecast here. So the average revenue increase over the next 5 years, they're saying 5.7% revenue growth. Now, when I compare that on stockanalysis.com, we go to their forecast page. This is pretty close. This is roughly in line. You see 6, 4.7, 4.2. So, but they're only giving me 3 years of projected growth on the from the analysts. So we're going to go with the 5.7% from Morningstar. And just a couple things to note here on Morningstar. Let me scroll back up to the top. So business strategy and outlook. Realty Income Corp is the largest triple net REIT in the United States with over 15,600 properties that mainly house retail tenants. The company describes itself as the monthly dividend company, which is also cool. It's nice to get monthly dividends. And its line of business and operating metrics make its dividend one of the most stable sources of income. Even though 80% of Realty Income Corp's tenants are in retail, most are focused on defensive segments. So we've got defensive segments, we've got triple net, and we have a strong track record of not lowering the dividend. So, excuse me, I'm just getting a little bit of an itchy eye. Okay. So Realty Income Corp looks really strong in terms of, the category that it's in. But the main question, or I should say one of the most important questions, is what is it look like in terms of discounted future cash flow? So we're going to go with, over the next 10 years, we're going to go with Morningstar's projection of 5.7% revenue growth on average. We are using a discount rate of 8.13. And given a revenue growth of 5.7, a perpetual growth rate of 3% going forward, 8.3, we're also assuming that it has the same profitability that it has now going forward. And actually, Morningstar does comment on their future profitability. Let me pull that up really quick. Oops. Where's that graph that I was at? Okay. Future profitability. So let's see. Operating margin. So in 2024, Realty Income Corp had an operating margin of 42.6%. And going forward, they are projecting a higher operating margin. So what I'm seeing is much higher, actually. So even if we go to net margin percentage as well, in 2024, they have 16%. The Morningstar projection is 25.9% going forward. So their profitability is lower now than it probably will be in the future. So if I use their profitability now, then that's a conservative baseline kind of starting point for where they're going to be in the future. So likely my projection is even a little bit more conservative than what it should be, given they're likely to be more profitable even going forward. Higher free cash flow, or a larger amount of free cash flow for each dollar of revenue. So right here, I'm only projecting forward the revenue increase, and I'm assuming the same profitability. So 15% undervalued currently. So the fair share price today, according to these calculations, is $69.50. The current share price for Realty Income Corp is $60. So that represents a 15% upside today on top of my 8% desired return going forward. And that 8% does include the dividend. It includes all of their profitability. So in the event of a recession, Realty Income Corp seems very undervalued. This is one of the companies, one of the REITs that I'm looking at for recession proof. So, okay, on to the next. I've got 3 REITs that I'm looking at for this episode. And then I have kind of one, I guess we'll say a bonus stock that I'm also looking at. So the next category, kind of gave a little bit of a spoiler a second ago. So we had consumer staples. Realty Income Corp looks like it's really strong as a consumer staples REIT. Healthcare, I already mentioned, we're not going to do healthcare on this live because I'm already covering one in a upcoming YouTube video. Next, let's look at utilities. So water, gas, electric. I'm not doing a REIT for water, gas, electric because I also want to capture a rising trend. I'm going to call this a utility. Maybe it's not technically a utility, but in my mind, data centers are becoming a utility. I mean, they are integrated into so many businesses. It is a rising tide currently. A rising tide tends to lift all ships within the industry. So I'm curious about data center REITs. Companies utilize data centers. As long as these companies are not going out of business, the REIT will continue to bring in the rents. So data centers, how robust are they for a recession? So this is just, this isn't anything too crazy. I just did a Google search for data center REITs. This particular article says data center REITs offer investors the opportunity to invest in a recession-proof sector of the real estate market. Data centers are essential infrastructure for storing and managing digital information. And just, it seems like every company in the world these days needs to manage digital information. It's a part of everyday life now, making them in high demand regardless of economic conditions. During times of recession, businesses and consumers rely even more on data centers for storing critical data, conducting online transactions, and accessing cloud computing services. So I want to dive into data center specialized REITs. Not only does this give me some protection in the event of a recession, it also gives me exposure to the industry that involves data centers, which has just been on an absolute tear. So I like it in terms of it feels like it has very high upside potential. It also feels like a defensive play all wrapped into one. So the data center company that I'm looking at, spoiled this a little bit earlier. Oh, now it switched. Okay, but here we go. I don't know what it is about Charles Schwab. It's not really giving me a good representation right now. I was just talking it up and now it's not clicking. So, okay, let's just move right along to the report. So the way they do this is they highlight it orange when they reckon it's overvalued. They highlight it blue when Morningstar believes it is undervalued. And so it has just recently crossed into undervalued territory. According to Morningstar, they give it a narrow moat, which is always nice. The reason this particular company has a moat is it has very high switching costs. So once you start, it's very sticky. People tend to not want to switch, and it has a very large network. So once you're a part of a very large network and you're benefiting from the network, it's difficult to move away from it because other companies that have a smaller network don't have the same benefits. So they've got a large network, they've got high switching costs that gives them a narrow moat. Now, in terms of what kind of revenue growth are we to expect going forward? Oh, they also give this nice kind of breakdown on what the bulls say and what the bears say. Equinix, with its portfolio of network and cloud dense data centers, is well positioned to benefit from growing cloud adoption. Yes, high upside. Secular trends and innovations like artificial intelligence and the Internet of Things will increase demand for highly connected data centers, such as Equinix. Equinix is positioned globally to benefit from growing data center consumption in international and emerging markets. Okay. Bears say Equinix's biggest source of competitions is the largest customers, cloud service providers, leaving it at the mercy of these companies over the long term. Okay, maybe so. Maybe there are some long-term risks associated with this company. Power densities have increased as firms rapidly invest in artificial intelligence technologies and scramble to find more power-efficient solutions. Okay, it seems like it could be more a problem with the whole industry. Power constraints in key markets will threaten Equinix's ability to accommodate new tenants. Okay, so it's got some risk. It's not all perfect. Okay. As far as revenue growth over the next 10 years. So, okay, here we go. Their leases are typically 2 to 5 years. So they don't have 10-year leases like we were looking at with, some other REITs, but let's see. I gotta keep scrolling down. Let me just scroll all the way down. Okay, where's the table? Okay, here we go. Revenue growth percentage forecast 5-year 9.1. So at some point, I missed it as I was scrolling. They actually gave a 10-year revenue projection with this company. Hey, Tommy Shelby, sorry, I missed you. Equinox is doing superb, not gonna lie. Yeah, I pretty excited about this company. We're just getting into it. So they give their 5-year revenue forecast right here, 9.1%. Further up, they gave a 10-year projection. Maybe I'll just do a search for 10-year, maybe. I know I saw they gave a 10-year projection. Oh, I remember. They said a top line. Okay, we project annual top line growth to average 9% over the next decade. So they're saying it. They think 9% revenue growth on average for 10 years. Okay, what about because I use their current profitability as the baseline going forward. What do they project as far as profitability? Let's take a quick look. Operating margin in 2024, 18.6%. Over the next 5 years, they're projecting 25%. So significantly more profitable going forward than they are now. Net margin, they're in 2024, 9.3%, but in the future, 17.1% net margin. So maybe double the profitability going forward. So I think it's an incredibly conservative baseline to just say, let's look at this company's profitability here and assume it's going to stay the same going forward. Very conservative. What was this? EQIX? Is that the ticker? Yes, EQIX. So let's do a quick free cash flow evaluation. 9% for the next 10 years. At their current level of profitability, that means they are 12% undervalued currently, with that's including the 8% annual return every year that we're looking for. So now I didn't do this with Realty Income Corp. Maybe I should have, but let's go to stockanalysis.com. Oh, I didn't do it because for Realty Income Corp, because Stock Analysis only gave us 3 years of forecast. But I believe with this company, they are giving us 5 years. So we can also see like a high, medium, low appreciation for the different analyst projections here. So let's go ahead and paste that in to the spreadsheet so we can actually see a few different possibilities here. So if the highest, what's the word I'm looking for? The highest projection for analysts, they're looking like they're averaging about 19% revenue growth over the next 5 years. If the highest analysts are correct, then we're seeing a 72% upside. The average analyst is in line with Morningstar, about 11% upside. And then the lowest analysts are saying a 30% downside. So this company, Equinix, what is their current dividend? So if we see a recession, their dividend is not huge, only 2.26%, but they're in a strong industry. They're benefiting off of data center growth, and I think they're going to be relatively sticky during a recession. They have a narrow moat, so companies are not likely to change providers because it's going to be more expensive to change. So in my mind, Equinix, very strong recession play, and also gives me a little bit of exposure to the high upside of the data center industry. Brian, this thinking strategy is great for uncertain markets. I 100% agree, Hokage. 100% agree. Let's see here. Okay, so that's two companies. So we've got. Maybe I shouldn't call it utilities, but I'm calling, at this point, I'm calling data centers kind of like utilities. So the next company, which is not on this list explicitly, is self-storage. I think that self-storage REITs, so not the self-storage business themselves, just the one who owns the land, owns the buildings, they get paid rents no matter what. So as long as the self-storage is not going out of business, then the REIT is still making money. So why self-storage? Okay, let me pull up this page here. How is self-storage recession resistant? Consistent demand. So I thought this point right here was very interesting. During recessions, individuals might move to smaller living spaces to cut cost, which could require storage for excess belongings. Similarly, businesses might downsize their office spaces, needing a place to store equipment and inventory. So in the event of a recession, we actually see additional need for self-storage. So not only do we benefit from the dividends, not only do we benefit from just the business needing to stay alive to pay the rents, we're also benefiting from possible increased demand during a recession. So, oops, get that off of there. It looks like a home run. So what is a good storage REIT? Where are we? Oh, spoiler alert. Here we go. Public Storage, PSA. This is the one I'm looking at. And also, I missed a couple things on Equinix. So Charles Schwab, their own equity report gives it a D. I wanted to point that out. So not every analyst is on the bandwagon for this company. However, their long-term growth, this report is also saying 9%. So regardless of their conclusion, given a 9% revenue growth rate, I mean, I think Equinix is still solid. And then Argus gives Equinix a 12-month buy rating and a 5-year buy rating. They also second or third the so forecast growth. So this is earnings per share growth. I can't remember if I feel like they also give a revenue growth projection of 9%, but I can't remember where it is. But anyway, I'm getting distracted here. Let me stay on task with Public Storage, PSA. So the revenue growth projected by Morningstar over the next 5 years, 3.1%. So not super crazy. The profitability, okay, operating margin in 2024, 46.6%. 5-year average, 46.4. So it's basically the same. Net margin, 39.9. Going forward, 37.4. So in this case, using the same, free cash flow to the firm margin percentage, 46.8 in 2024. 5-year average, they're saying for their forecast, 41.7. So this company, on the other hand, might be going down a little bit in profitability going forward. So we have to keep that in mind. So whenever we're doing our free cash flow valuation, let's remember that maybe this one is not as conservative as the other two. But I love the sector that it's in. When I look at its historical performance, I can see that they've been growing their revenue every year for the last 10 years. And I just realized I didn't look at the. Tommy Shelby. Whoa, McDonald's founder vibes. I'm not familiar with the McDonald's founder. Are you saying that I'm giving McDonald's founder vibes? Anyway, I just realized I did not showcase the dividend history of Equinix. So let's go back to that really quick. So Equinix, if we look at 2022, short recession or short bear market, short recession, they did not drop their dividend. They actually increased it. 2020 COVID, they did not drop their dividend. They increased it. So they have a short but a strong history of increasing their dividend every year for the last 10 years, except for 2015 where they had a massive special dividend. I did not research why they did this, but they gave a massive dividend in 2015 and then dropped it back down. So with that one exception. So decent dividend track record for Equinix. And then Public Storage, PSA, we can look at their dividend history. Okay, dividend growth. And 2000, they dropped their dividend by 2 cents. So that basically they kept it basically flat, and then they were increasing it again in 2001. In 2008, they went from 2.8 to 2.2, so a small drop in their dividend in that following year, 2009. But then they were up to 3.05, so 2.8 to 2.2 to 3.5. So they were already back on track within 2 years. In 2020, during COVID, they kept their dividend flat, and then in 2022, they gave a massive special dividend, and then they dropped it back down in line with their previous growth trajectory to 12. Still like a pretty big increase. So it looks like they were, this is a little bit of speculation, maybe they were holding their dividend constant during COVID because they were unsure if they were going to need the cash. And then when they realized they were looking pretty good, they paid it all out in a special dividend, perhaps. That's a guess. I don't really know that. But strong dividend performance for Public Storage. So let's look at their free cash flow valuation, though. That's what it all comes down to. PSA. So at 9%, they are having a massive upside, but let's drop it down. What did we say? 3.1. So if we just say what was it? Was it 3.1? I'm misremembering. Yeah, 3.1. So at 3% revenue growth, or I'm just going to make it 3. I don't need to mess around with 3.1. So at 3% revenue growth, this is saying 6% overvalued. So it's a little bit overvalued. Basically, it is fair price, essentially fair price. If we go to their forecast, oops, another spoiler. Let's go to their forecast so we can see the high, medium, and low. Oops. So the upper end on the revenue projections from analysts is quite high, 13%, 18%. Let's paste that into here. But in line with the average projection, that with this one exception in 2027, it's relatively low revenue growth. So with this company, we're seeing a 36% possible upside, 39% possible downside. I would say this one is pretty much fair value, maybe slightly expensive, very slightly expensive. 5% overvalued is really not much in my mind. So if I were to invest in a company like this, it would be mainly for the downside protection. I'm not seeing a huge upside with this company, but it seems to be uniquely situated to just perform well if you're very worried about a recession. Now, other things that you would want to keep in mind if you're really just wanting to maximize for a recession performance is to be properly diversified. I'm not advocating for you to just invest in 1 or 2 REITs and then consider yourself 100% safe for a recession. You would want to make multiple investments, be diversified across many companies, many sectors. That would give you the best protection, the most defensive portfolio for a recession. Hokage says, Ray Kroc made it mandatory to lease from McDonald's Corp. If anyone needs a franchise of McDonald's, it's a smart move. I've always heard that McDonald's is actually a real estate business, not a fast food business, because all the McDonald's locations, or not, I shouldn't say all, but there are so many just prime real estate McDonald's locations. So if ever the McDonald's business wasn't doing well, they could rent that space out to anybody, because there are so many that are just in prime locations. So it's interesting you bring that up. Anyway, so PSA, not my favorite choice of the ones we've looked at so far, but I felt like I had to bring at least one self-storage REIT. It just seems like a really nice niche for defensive investing. And then finally, the last, this is a company that I came across while I was looking into PSA. This is a storage REIT. However, it's not your typical storage REIT. Americold Realty Trust. This is a REIT that specializes in cold storage. So they do say on here, the narrative has shifted significantly as investors no longer view cold storage as recession resilient or as having stable cash flows. The speculative supply problems is more severe than previously anticipated, and there has been a shift in the long-term demand outlook. So they have been having some issues. This particular company, Americold, has dropped so much in share price. The reason I'm including it in this live is because it appears to be incredibly undervalued. And I'm going to get into the free cash flow analysis here shortly. If I can go to the overview, taking a minute to load. Okay. Over the last 5 years, has dropped by 63%. So a lot of this started during COVID. There was a lot of oversupply after COVID. Things slowed down during COVID, and this company has had some issues, basically. If we look at the financials, we can see that since 2022, their revenue has been going down slightly. So they had pretty strong, consistent revenue growth going into COVID, really strong in 2021, but then they've had some oversupply issues going forward. So I do want to bring that up. The bottom line, We plan to maintain a $27 per share fair value estimate for no moat rated Americold, and we believe that the shares offer a comfortable margin of safety for investors. So basically, Morningstar is saying the stock price has dropped way too far. There are some structural problems with this company, but it is trading at such a discount that the risk reward makes sense. That is what Morningstar is saying. So let's look at what they're projecting for future growth. Okay. Revenue growth, 2025, they're thinking they're going to have revenue shrinkage, but going forward back to profitability. Their 5-year compound annual growth rate is 4.6, but it looks to be trending higher towards 8% beyond 2029. So we're going to account for that a little bit in our free cash flow spreadsheet. Margin metrics. Oh, wait. Oh, shoot. Sorry. I was looking at revenue growth. So operating margin percentage, 2024, it is 8.7%. The 5-year average is 6. So I am using their most recent margin. So a little bit, looks like I should be accounting for that a little bit in that their margin may be a little bit worse going forward. But free cash flow margin, this is actually what matters a little bit more. Free cash flow to the firm margin, 2024, negative 2.3, going forward 6.7. So maybe my current margin, actually, I would say that my current margin assumption is pretty conservative. So taking that into account, 5-year forecast for revenue growth, 4.6%. The ticker is COLD. Oh my gosh. I already having dementia. 4.6. Sorry, not 5. What am I doing? 4.6. It did appear that it would be a little bit more beyond year 5, but we'll just call it 5% revenue growth. So given 4.6 average over the next 5 years, 5% average in years 6 through 10, 3% in terms of perpetual growth rate, this company is 43% undervalued. There's a 43% upside on top of our 8% targeted annual return. This company is insanely undervalued if they are able to achieve this revenue growth going forward. That is a big if, but that does represent a pretty large potential upside, especially if they have the profits to back up this projection. I mean, if they have the dividend and they're able to continually pay their dividend, and then I can take that dividend and then continue to invest in more shares, then I can, in that way, I can really benefit from an undervalued stock, especially during a recession. So let's see if I can get this to load. I want to look at their current dividend. Man, my internet is just going slow. Oh, okay. Hokage, great question. Why is my past free cash flow margin tab erroring? Great question. I should have talked about this sooner. So these REITs do not have free cash flow in the typical sense. So let's change gears really quick. It is important to explain this. So REITs don't have free cash flow. The acronym that they have in this case is FFO or AFFO, Adjusted Funds from Operation. So as you know, my spreadsheet is automated, so I had to make some adjustments on the spreadsheet to handle REITs. So a REIT, the main metric to look at is the Adjusted Funds from Operations per share, or in total, Adjusted Funds from Operations. So in 2024, Realty Income Corp had $3.6 billion funds from operations. This is the free cash flow equivalent. So this is the money that they are looking at dividing up. A huge portion of it goes into dividends because REITs are required to put 90% of their profits into dividends. Now, funds from operations is not profit. So if we go to, let's see, dividend, earnings per share. So their earnings per share right here is like basically $1 per share, and yet their dividend is 3. So it looks like they're paying out 300 times, their earnings in dividends. How can they afford that? Well, REITs have tons and tons and tons of depreciation, and so they can take out they can make it look like they're not profitable on paper, but they have the cash. The cash is coming in. So the term here is adjusted funds from operation. I have not built my spreadsheet to show this in a clean way. So I just kind of left it. It's not taking into account free cash flow. It is using the most recent adjusted funds from operation. Hokage says, I remember now. I think you explained it in the NLCP stream too. I think I probably did. I probably did explain that. But no, good question. That is, if you're familiar with the spreadsheet, then I can see how that would be like a red flag. Like, Brian, what are you calculating here? You have no free cash flow margin. So valid question. Okay, cold. Let's get back on cold. So where was I? Yes, here I was. I was going to look at their dividend and it wouldn't load. That's right. So their dividend currently is 6.78%. That is a fat dividend. That's a large dividend. So if this company is able to continually put out a high dividend, like, they set their dividend, and then if their share price goes down, the yield continues to go up. And if their share price goes down and they're still paying out that same dividend, then I can continue to buy more shares of Cold using the dividend, and I can really build the dividend snowball, as people like to say. So this company represents a significant asymmetric bet, in my opinion. It's a REIT. It's storage. Maybe it's not as recession proof, but it's so undervalued right now, considering the projected future revenues, their current profitability. This company, especially if they're more profitable going forward, this company looks to be a really, really, really tempting buy, especially with the 6.8 or 6.78% dividend. Now, what does the forecast say? On average, analysts like it. They've got it at a consensus buy. There are a few analysts that are not happy with it, that say sell. Like I said earlier, there are some fundamental problems with this company. Now, most of the recent analysts, as of September 25th, are saying strong buy. There is one hold from Barclays. Anthony Powell says buy. So there's lots of buy ratings out there. Morningstar gives it a fair share price of 27, which is a huge upside. So this company is really interesting to me. In terms of their projected revenue, let's copy and paste this into the spreadsheet as well. Okay. So our high, medium, and low, we got 112% upside. If the most, what's the word I'm looking for? Blanked out on this word earlier. The analysts that, I don't know why I'm blanking on this word. The analysts that think the stock is going to perform the best say, based on their revenue projections, 112% upside on top of our 8%. Average analysts put it at a 47% upside. Morningstar, their projected revenue increases put me at a 43% upside, and then the lowest analyst projections put me at a 21% downside. So can they afford to keep paying their dividend? That's a question that a lot of people like to ask. How do you determine how safe a dividend is? Well, what you do is you look at their dividend per share. Where is it? Dividend per share, 88 cents in 2024, 90 cents over the trailing 12 months. Yeah. Okay. Dividend per share. We'll look at the 88 cents. We'll look at 2024. Adjusted funds per share, $1.47. So what is that math? 88 divided by 147. So currently they're paying out 60% of their funds from operations in a dividend. That is a big margin of safety. Most REITs are paying out a much higher percentage, much higher. In New Lake Capital Partners, they were sitting at 79%. That's a more normal payout ratio. So 60% dividend seems pretty safe. Let's look at a couple of their other financial metrics. How much debt do they have? Interest expense is relatively high, not going to lie. Their operating income is 191. Their interest expense is pretty high, so they have a fair amount of debt. How much cash do they have? They have 101 million in cash. They're I mean, they don't have the best. It is a REIT, so there's going to be a lot of debt with REITs, because that's the name of the game. If you want to grow quickly, then you have to have some leverage. So that is it's not the safest thing during a recession. One of the things I love about New Lake Capital Partners, like Okajay brought up, is they have incredibly low debt, tons of cash on hand compared to, they have more debt, they have more cash on hand than they have debt. So that makes them a lot safer. But with this company, very asymmetric risk profile. So those are the 4 REITs that I'm looking at. I did not invest in a company last week, so I'm going to do 2 companies this week. The 2 companies that I like the most. I'm not going to lie, I'm a little bit torn. I'm doing Equinix for sure, because I like the data center upside. I'm torn between Realty Income Corp and Americold. And to be honest, I might just do 3 companies this week and just do a bonus, just $100 into each, 2 to make up for last week, and then 1 bonus because I just kind of stumbled upon this company as I was doing my research, and they just seem so undervalued. That's a little bit off the topic of recession-proof investing. So I can't say for sure that it's going to be doing really well during a recession because of the issues they're having. But it just, when it's so undervalued, it's hard to pass up, especially with the high dividend. We're just going to do 2. I'm going to hold back on cold. I'm going to keep it in line with the theme of this week's stream: recession-proof investing, Realty Income Corp, and Equinix. Okajay says they might benefit from upcoming 2 interest rate cuts this year. 100%. You are right about that. If we get those interest rate cuts, all of these REITs that I've been investing in are going to benefit very nicely. So that's a great point. But yeah, this week we're looking at 2 investments: Realty Income Corp, Equinix. I'm also going to pull up my portfolio. So guys, anyone who's watching, if anybody has a company that they want me to look at, we can do a quick discounted future cash flow projection and see what it's looking like. Just a very quick dive, nothing super deep. But yeah, if you have any companies that you want me to look at, don't be afraid to shoot it into the comments, and we can check it out. Let's see. Let me pull up my portfolio. We can see we can do a quick recap. Okay. So we are at 5.5. We're coming up on a year pretty soon. Now, oh, what happened? Okay, here we go. We're coming up on a year pretty soon, investing roughly $100 per week. Some weeks we did a little more. Some weeks we did a little bit less, but on average, most of the time it's about $100 per week. How's the performance? HIMS, as always, looking really good. It's come down a little bit lately. ASML, Google, UNH, GenMab, BTI. The stock market was pretty red today, but British American Tobacco was one of the only green companies. Okay, Okajay, Costco, and Yum Brands. Okay, Costco. Man, I would love an opportunity to buy Costco. I think Costco has a really good business model. It's a great company. Unfortunately, everybody knows it, and it always seems to be just overpriced. Every time I look at it, everyone knows it's good, and if it's always overpriced, in 10 years, if it's still overpriced, then it'll be a good investment. It'll have the returns probably, but I just can never bring myself to it. I always assume it's going to be fair priced in the future, and so I need to invest in it when it's either fair priced today or underpriced, according to my best, research. But let's look at it. Let's look at Costco right now. Yeah, I love the company. I love how they can have incredibly cheap products, and because they have a membership fee. They are making money. Like that membership fee is like 100% profit. They're making money on that membership fee no matter what. So let's go to the forecast. The analysts love them. Consensus buy, of course. Costco is the best. Let's see here. Revenue growth. Pretty strong revenue growth. I'll tell you what, being in Texas, another grocery that if they ever go public, I will be investing is HEB. Man, HEB is pretty much only in Texas, so they have tons of room to grow. Texans love HEB. I'm waiting for the day that HEB goes public, man. Okay. Costco. How are we looking? Revenue growth. Let's paste it in. Alrighty. So yeah, you can see, man, it's just unfortunate. Even the highest analyst projections are putting it at 43% overvalued. Now their past free cash flow margin, let's see if we can adjust their free cash flow margin at all. Let's see. It looks like we can bump them up a little bit. Let's bump them up to 3. I'll bump them up to 3.5. If I bump them up to 3.5, a significant bump, and we give them credit for 7% revenue growth over the next 10 years, which is their past revenue growth, it's overvalued still. You know, I hate to say it, but Costco is a great company. Everybody knows it's a great company, and so everybody buys that stock. Can't do it, Hokage. Someday maybe we'll get the opportunity. If we have a big recession, people get scared, maybe Costco will drop enough to be fair valued. I tell you what, with a company like this that has been so consistently overvalued, if it ever dropped down to fair value, I think I would have to scoop it up. I would have to. And if we look at their historical price to free cash flow ratio, I bet you it hasn't dropped much. I bet it's always been high. Where's that price to free cash flow ratio? Right here, price to free cash flow. Okay, it dropped down to 35 at one point, 37. It was 25 at one point, 16 at one point. Man, it was 111. It dropped down to 16 in 2017. That could have been, maybe that was an opportunity. 53. So it's actually, I mean, for the last 3 years, it's been pretty high in the 50s. And it's been in the 30s before, 67. You know, I'll have to keep a close eye on Costco, especially if the stock market dips. But yeah, in the meantime, unfortunately, I cannot bring myself to do it, man. It's just too good. Everybody knows it. Okay, Yum Brands. Okay, over the last 5 years, it's been kind of steadily going up. Small dividend forecast. Analyst consensus is a buy. Revenue growth is all green. Even the lowest analysts are saying they're going to grow their revenue. So that's always good to see. Let's see. Paste in their revenue growth. Hokage says we just need to wait patiently. Yep. You're 100% right, man. Costco, I think we're going to have to be very patient for Costco. Okay, so right off the bat, without making any adjustments here, Van Marin 962, could you do Path or Plab? Yes, I can. Plab is a familiar name. Plab. We bought Plab a while back. I loved it then. It's up 26% for me. We'll do it. We'll see if it's still undervalued. I'm probably not going to be selling it, but it may have risen up to be a bit overpriced. Okay, but hold on. Let's finish with Yum here. So their past free cash flow margin is 19. Do we want to adjust their past free cash flow margin at all? 19 is about right. I think 19 is probably pretty safe to go with for free cash flow margin. So we're going to leave it at that. Based on the highest analyst projections, it's fairly valued today. So if we were going to beat 8%, if we're going to beat that, they have to do better than the best analysts think they're going to do. So Okaje Brian not only bought PLAB, but averaged up again a few weeks back. Yep. PLAB is it's a good one. It's a good one. Okay. So yeah, I'm gonna say Yum. I don't know much about Yum. It looks like a lot of people like it though. It's not as bad as Costco. But and when I say bad, I just mean people love the stock. And so it makes it tough to get it at a good price. But yeah, they've been consistently increasing their revenue, except for they had a bit of a bad streak here from 2015 to 2019. They actually lost revenue a bit in those years. Interest expense is very low compared to their operating income. Love to see that. They're doing share buybacks. Love to see the share buybacks. They have pretty high margins. I mean, this looks like a strong company for sure. Let's look at the Warren Buffett indicator here. So lots of green flags. One red flag is the long-term debt divided by profit, but their interest rate is low enough to where, maybe it's a little bit of a red flag. And then capital expenditures is low, depreciation is low, plenty of cash on hand. It looks like a solid company. If this company ever dropped in share price, this would be a prime candidate for investment. I think it's just a bit too expensive right now. Yum owns Pepsi, Pizza Hut, and Taco Bell. Yep, I believe it, man. Those are some good brands, and they look like they're doing very well. Okay, let's check PLAB. I haven't looked at PLAB in a while. Let's see. Oh, wait. That's a big upside there, but hold on. Let me make sure I'm not tripping really quick. PLAB. If it'll load. Man, my internet is just... I hope the stream hasn't been affected by this. Is it laggy or anything for you guys, or is it good? Because my internet is going so slow. Financials. Okay, yeah, okay. I just wanted to make sure it was USD, because a lot of times when I see that, it's in another currency. This is like insanely undervalued, but I do have the wrong growth projections in there. Critical process died. Good evening. Any predictions for MU? Hey, we can look at MU after this. I'm not going to say, I don't have anything to say about it off the top of my head, but we can do a quick free cash flow valuation. Have not done a deep dive on MU, but yeah, I'm down to check it out really quick. Okay. PLAB forecast. Yeah. Look at that. The analysts they all agree this stock needs to go higher. Okay. Forecast. So we don't have the best revenue forecast, unfortunately. Let's see if, on Charles Schwab, they have the Morningstar analysis. Let's see. Oh man, the internet's going so slow. Okaje MU was a big miss for me when they dipped. Should have scooped some. Yeah, it wasn't on my radar either. So maybe we may have missed out on that one. Gosh, I cannot get this to go. Okay, let's do our own here. Okay, so the average analyst projection is saying they're going to have a rough year in 2025, but they're going to do well going forward. PLAB is big on share buybacks. Love to see it. Okay, let's just say, yeah, we have a huge part of this massive undervaluation is due to our assumptions. We have some pretty big assumptions in there. So let's say, okay, we have 3% revenue growth starting now, going on forever. So if Plab is just able to increase their revenue with inflation, then they are having an 89% upside. Should we adjust their free cash flow? 16% on average, but they had a really low year in 2021. So this average might be pushed down a little bit too much because of that really low year post COVID, maybe. We've got 14 in there now. Let's bump it up to 16.42. And let's assume that they increase their revenue less than inflation going forward. And we still have an 80% upside. This company it looks so good. This company looks so good. Still undervalued. I would still buy more. Unfortunately, I don't. I like to keep this YouTube portfolio as diversified as possible, so I can't just continually double down on all of my highest conviction picks. But yeah, with Plab, that was a high conviction pick. We doubled down on Plab. You can see we put 200 in that one. Okay. They're big on share buybacks. Yes, they are. Let's look at that. If I can get this to load. Man, it's just taking forever. Okay. Yep. Bit of inconsistency in some years. 2018, they had to dilute a bit, but then they bought it all back. Oh, this was see, this is the shares outstanding diluted. So this is like stock options probably that they give to their executives. So maybe they bought them all back. They issued shares and then bought them back maybe. But yeah, their share count is consistently going down. 66 million down to 61 million. So pretty consistent share buybacks. Yeah, love the company. Okay, let's look at MU. Let's get MU. They were not on my radar. I did not do much analysis. And they've had tons of revenue growth over the last couple of years. That's insane. Let's look at the forecast. So the analysts are actually saying that they're a bit overvalued now. But we don't just trust their stock suggestions. We got to take into account the revenue, the free cash flow. Yeah, no problem, Van Maren. Okay, MU. What do we got? Okay. Man. Well, okay, actually I have a negative free cash flow margin. So what is their free cash flow margin lately? So yeah, in 2023, they had a major drop off in free cash flow, negative 34. Let's go with 9. Let's go with their most recent free cash flow margin. It's kind of in the middle of 3 and 15, it's not the most scientific way to do it, but let's give them 9 and see what it looks like. If we give them a 9 and we say, let's give them credit for a perpetual growth rate of 3% revenue. Let's give them a year 5 through 10 of 10% revenue growth. Next 5 years, 10%. So if we just say that they're going to grow their revenue by 10% every year for the next 10 years, and then they have a perpetual growth rate of 3%, then they are still significantly overvalued. So what is the market? This is an exercise I like to do to see if I believe, if I believe the story. Let's say 15%, they're still overvalued. Let's say 20%. If they increase their revenue by 20%, then they've got a little bit of a discount right now. So how likely is it that Micron is going to increase their revenue by 20% on average every year for the next 10 years with their current level of profitability? That's the question. If they can do that, then they're like pretty much they're close to fair value today. I don't know enough about this company to say how likely that is, but just looking at the analyst projections, the analysts are saying, over the next 2 years, they could put up those numbers maybe on average, like 46 and then 10. That's pretty good over the next 2 years, but then the analysts are not really giving the same story after that. So the 20% seems a little bit tough just looking at what the analysts are saying. I haven't done my own deep dive on Micron yet, so I can't say if the analysts are right or wrong, but the analysts do not seem to think that 20% is happening for 10 years. So I would tentatively say that it seems like Micron is overvalued. What else? Okage said I need to update revenue estimates, but that comment was old. Sorry, I don't know what I missed on that one. Plab, big on share buybacks. Thanks for checking in on Plab. Van Maren, check Brian's live stream with the title Cannabis Stocks. Yeah, that was. I think that's a good stream, and I think there's some real potential with the cannabis stocks. Now, do I have any idea when they might be rescheduled? I mean, the longer it takes, the more I doubt when it's going to be rescheduled. That's why I'm so big on finding cannabis companies that are making it work now in the current environment. Green Thumb, they're profitable now. New Lake Capital Partners, they're profitable now. They're a REIT. So as long as the cannabis businesses, as long as they're not going out of business, the REIT is going to continue to make money because they have all triple net leases. Their average lease duration is more than 10 years out. So those are the companies I'm liking to invest in now. And if rescheduling happens, then it's going to be a nice boost. But in the meantime, they will hopefully still deliver returns. Not cannabis, cannibal. Oh, did I misread that? Oh, my bad. Cannibal stocks. I'm sorry. Yeah. Okay. You're talking about the share buybacks. Yes, sir. Yes, sir. Critical process died. Thank you, man. Yeah, no problem. Happy to check it. What else? I feel like I missed one. There was Plab, and then there was one more. Path. Let's look at Path. Oh, yeah, that's right. Hokage, you did a deep dive on Plab, Adobe, and another stock on share buybacks. Yes. Yep. Yeah, I remember now. I just read it as cannabis because that's been the investments on my mind lately. Okay. Path. Okay. The analysts are a little bit all over the place on Path. There's only 3 years of projections, but the projections look pretty good. Okay, and we're going to continue. I got to fill in these next 2 years, so I'm just going to pull these out of my butt. I'm just going to do more of the same. Just going to continue the trend. Oops. Okay. So that is our projections for Path. Free cash flow margin. Oh, I need to adjust this. We'll say 15 and 5. Let's make it 15 and 15. So even if they're able to have 15% revenue growth for the next 10 years at this level of profitability, it looks like they're a bit overvalued. In terms of profitability, we're seeing some major red flags here with this company. Stock-based compensation. Okay. Stock-based compensation is a major problem here. We'll give them a little bit of credit back for R&D, which will help out a bit. But I'm basically saying stock-based compensation is eating up like all their free cash flow. So let's look at, what do I mean by that? This is a good case study. Okay. Okay, so here's the income statement. They start, you start with their revenue, just a quick crash course on reading financial documents. They got their revenue, and then you have to take out the cost of revenues to get gross profit. Then they factor in their selling, general, administrative expenses, research and development, and they end up with a negative operating income. So they're losing money, and then they're having to pay interest. Oh, no, sorry. This is interest income. Sorry, my bad. They're not paying interest here. Okay, after gaining their interest and investment income, they're now positive, and their pre-tax income, they now have positive pre-tax income, even though from their operations they lost money. So they lost money from their operations, but because they have some investments that are giving them income from their investments, not their primary operations, they're able to have a little bit of profit. Okay, so they have some profits. They have $309 million in free cash flow, even though they only have $12 million in profit. How is that? Well, to find out, we go to the cash flow statement. So on the cash flow statement, you start off with your income, and then they add back in expenses that are non-cash expenses. So depreciation and amortization. These numbers reduce your profit, but it's only on paper. It's not actual cash leaving the business. So they add these non-cash expenses back in, and it represents your actual cash flow. So stock-based compensation. This is compensation. You're paying your employees, but you're giving them stock. So cash isn't really leaving your hands. Stock is leaving the company. So they add $329 million in to show their operating cash flow. Okay. So they have $334 million in operating cash flow because they paid their employees not with cash. Okay. Well, I don't like that, because what's the effect of this $329 million in stock-based compensation? Let's go down a little bit. Here, look at this. Repurchase of common stock. So they took all this cash flow that they had, this $334 million, and they used $560 million to buy shares back. So they gave their employees stock, not cash, and then they used their extra cash to then buy the stock. So they really are pumping up their cash flow. Right, this operating cash flow looks good. So to calculate your free cash flow, you take your operating cash flow minus your capital expenditures. So it looks like they have, hey, look, they're positive free cash flow here, $300 million in the last 3 years. But the only reason they have this cash flow is because they're just paying out tons of stock to their employees, and then they're turning around and they're actually spending even more cash to buy the stock back. So anyway, for me, this is a major red flag. They're not really using their cash. So normally, let me say this. How do I want to say this? The free cash flow is generally what I look at as my return on investment. As a shareholder, the free cash flow is the chunk of money that gets used for buying back shares, paying a dividend, or growing organically or growing inorganically through acquisitions. Normally that cash is put to good use, but in this case, the cash is used to buy back shares that it gave employees. Basically, it's just used to pay employees. So it's not really like a return on my investment. So, okay. Hopefully that all made sense. What about CRM? I believe they've been struggling lately. Not sure why, though. CRM. Let's see. Anyway, I hope that was all clear. So yeah, Path, even though it looks like they have free cash flow, they really don't, in my opinion. So I'm going to say this company It's not one that I would invest in. I'm not going to say that it's not going to turn out well in the future. It may turn out really well in the future. It may turn out to be a great investment, but it's not the type of predictability. I don't have any confidence in the prediction at all if I can't look at like some kind of predictable free cash flow that's going back into the business to fund its growth. So not my kind of investment as of now. Okay. CRM, Salesforce. Okay. I'm familiar. CRM is like right off the bat. I have to still change the projections, but hey, it's looking good right now. Let's see here. Salesforce. Okay, this is gonna be the last one, by the way, and then it's past my bedtime, y'all. Okay, CRM. Let's look. Salesforce. Man, this internet is killing me. Come on. Load. Okay, Salesforce. Over the last year, it has been kind of dropping. So it's been kind of choppy the last 5 years-ish. Pretty much flat. Yeah, just choppy the last 5 years. But during that time, it's been able to grow its revenue like crazy. So this is a good start. I'd like to see that. Okay, forecast. Did I already copy this? No, I didn't, right? So all of the analyst projections are looking solid. Even the lowest analysts are giving it green. Analyst consensus is a buy. All of that looks really nice. Okay. The current assumption is a free cash flow margin of about 24%. How reasonable is 24%? Okage says, this is the longest live stream to date. Good night, Brian. As always, I'm joining with you on, probably cold instead of Equix. Fair enough. Equinix, I think is the way you say it. Fair enough, man. Whatever you think. Yeah, both of those to me look very interesting. So, I got no issues with that, man. Good night. Thanks for tuning in. I appreciate you as always, Okage. Always have a lot of fun whenever you tune in. So hopefully I see you next time. Okay, Salesforce. Where were we? So lately, their profitability has been really good, 27%. Stock-based compensation is quite high. Now, it's not like a huge percentage of their revenue like the last company. The last company was like 30% of their revenue. This is 8%. That's still a big chunk. I don't like to see it. The last 2 years, though, they've been quite profitable the last 2 years. But let's go with the average. Let's go with 17%. Let's go with the average. So we actually have to drop it down by 7. Right? Ish. Maybe that's a bit much. Let's drop it down by 6. Okay. So if we drop their free cash flow margin down to 17.88, right? Am I doing the math right? Yeah. Then suddenly the story looks a lot different. So they looked really good. Well, I say really good. What was I seeing before? They looked better before. I guess after I changed the projections, it went down quite a bit. So, it seems like it's a solid company. It's been choppy. It must have been very overvalued in the past. And now it's starting to catch up to its proper valuation. I would say, I need to do a little bit of research to see what kind of profitability we could expect going forward. If they revert to their mean profitability, if they go back to their average profitability over the last 5 years, then it looks like they're a bit overvalued right now. If 27% is the new normal, right? In 2025, looks like they averaged about, wait a second. Let's scale that back a bit. let's scale that back a bit. 26, 27. Okay. If that's the new normal, then they're probably a little bit undervalued. So I think this company, Salesforce, is really going to depend on, what is their profitability going to improve as we go forward, or are we going to start to see competition come in and see margin contraction as they're fighting to maintain? If they have a wide moat, if they have a strong resistance to competition, maybe they're going to have the pricing power going forward to keep their profitability up and grow their profitability. But in the meantime, I can't, with this one, it's not so obvious. This one, I think, requires some more research, a deeper dive perhaps, to say, is this company undervalued right now? Let's look at their financials a bit more in depth. While that's loading, let me go to my Buffett supplement here. So I'm seeing high margin, that's good. Green flags there. Low interest, that's a green flag. Their profit has been mostly up, but it had a big dip in 2023. Retained earnings have been going up. Green flags in terms of capital expenditures being low. Plenty of cash on hand. They've been starting to do some buybacks lately. Operating cash flow is on the rise. So, I mean, it looks like just at a quick glance, it looks like a strong company, but maybe a bit overpriced. This is one that I would want to keep a close eye on. And if the share price drops significantly, then maybe worth it to jump on. And it looks like it looks like just in the last week, it's gone up a little bit. So, but overall in the year, it's down. Anyway, interesting company. We'll keep a close eye on it going forward, but a little bit, I feel like maybe a little bit too high. Need to do some more research. Anyway, that's all I got for tonight, y'all. Thanks for tuning in. I appreciate all of you being here. We stream every Wednesday, starting the stream at 7:30 p.m. Central Time. I'm in Texas. Critical process died. Appreciate it, man. I'll be waiting on your full analysis. All right, very good. I'll look into Salesforce a bit more and see how I feel about the future profitability. That's what I'm really looking at. Good night, man. I appreciate you joining in. Everybody else, I'll see y'all next time, hopefully Wednesday. Not sure what the stream's going to be about yet. But I'll try to post the stream, what am I looking for? The concept for the stream ahead of time, so you have an idea, a little bit of a sneak peek. Van Maren, thank you. Thanks for tuning in, man. Appreciate you. All right, that's it, guys. Until next time. Good night.